She's the group's company secretary. Sandeep Sinha, he's our group executive general manager for credit. Shamir Patel, he's our head of personal and business banking. Kenneth Lukale, group head of asset and liability management. Billing Etich, he's our acting group CFO. L.A. Shivram, he's our group business development director. We have Gauri Gupta, she's our group executive general manager for corporate advisory. We have country CEOs who have joined in the call virtually. For Rwanda, Benjamin Mutimira; Uganda, Robin Besto; Tanzania, Zahid Mustafa; and Mauritius, Mark Watkinson. And then we have Gul Khan, he's our CEO for I&M Bank Kenya. And finally, Kihara Maina, our regional CEO, I&M Group PLC, and he's the one who'll kick us off this morning. So I now invite Kihara to come and take over.
Okay. Thank you. Good morning, and thank you for joining us today as we present our financial year 2023 results. So, this is a familiar slide. I think you are by now familiar with our footprint. Presence across 5 different markets, with our home market here in Kenya. Over 560,000 customers. That's an interesting new metric. You'll hear a bit more about it later. And now a network extending to 93 branches, 132 ATMs, over 4,600 shareholders, and over 2,800 staff. I'll just quickly go through the operating context that we had over the planned period that we have just closed in 2023, which is our Imara 2.0 strategy cycle, and in particular for 2023. So we started our Imara 2.0 strategy cycle back in 2021. And for those of you who recall, this was when we had just cleared about a year of COVID. And obviously, we're dealing with quite a number of challenges. Economic downturns, countries closing down, all of this leading to other challenges that we had on the supply side, for example. We also had geopolitical tensions that were affecting the markets around that time, and we saw depreciating currencies, which were forcing our economies to readjust. And that led to, of course, tighter monetary and fiscal policies. The important thing for us to note is that we were able to prevail through this period, and we feel managed to leverage on the tailwinds that we saw and also seize the opportunities that presented themselves. And our focus really has been on customer centricity, which has continue to lead us to be innovative and to focus on providing solutions for our customers, and particularly to help cushion them through those tough times in line with our brand promise. So if we look at how we did in that strategy cycle, let's take a bit of stock of that period. Just to recap, as you will see on the slide over there, our aspiration is to be Eastern Africa's leading financial partner for growth. We had in the Imara 2.0 strategy cycle 3 key pillars, focusing on business growth, resilience, and optimizing the operating model. And if we look at the period of that journey, it's actually started back in 2016, but this was the second cycle that we were going through. What Imara 2.0 helped us do is really set the foundation towards being a diversified banking group. So what kind of successes did we see? We saw our customer numbers more than double over that period of time. So 250,000 customers through to now. In 2023, we ended with 560,000 customers across the group. We enhanced our customer experience, which led to the Net Promoter Score, which is the metric that we track for how we are perceived by our customers, moving from 34% to 71%. In terms of the number of customers and really showcasing the investments that we made in digital, we moved from less than 50% digitally active customers to, by the end of 2023, 78% of our customers operating digitally. In terms of the business written, we saw growth in terms of new business to the group, move from about 10% to 22% in 2023. If we look at the contribution from our subsidiaries, and granted in 2020 we had a bit of an underperformance in one of our subsidiaries. That, however, moved from 5% to 24%. And prior to that, we used to see about 13% in terms of the contribution. And that rising to 24% is very good. So if we consider how we have achieved that success, we have focused really on customer centricity. And you will see that in terms of geographical expansion, over that period is when we closed on our presence in Uganda. It's also the time that we saw branches being opened right across our different markets, and you've seen that also here in Kenya. We moved from operating with what we call an investor model to an operator model, focusing on our regional businesses and supporting their growth. And we saw that we were generating now, please just move to the geographical diversification slide. We were now generating about $3.8 million from our cross-border business development initiative, really focusing on who are our clients in our different markets, how can we make sure that we are serving them seamlessly across our different markets. I've already talked about the contribution that came in from the subsidiaries, and we expect to see over time that number rise and see an even greater contribution from our subsidiaries. If we look at our segment expansion, we have seen Imara help us to really create the kind of propositions that are relevant to our customers. It has helped us grow our customer numbers and, more importantly, also improve the deposit mix. So if you look at our customer numbers over the 3-year period, compounded annual growth rate of 31%, the deposit mix, most importantly, greater contribution coming in from our current accounts and savings accounts. That helps with managing our margins. We move on to the segment expansion and look at the corporate and institutional banking space, which has been, as many of you will know, our mainstay. We feel that this is where our greatest strengths are. So we've been continuing to consolidate in that space. And you will see that we have also been expanding into new sectors, in particular the oil and gas sector, looking at building our capabilities there in Kenya, in Uganda, and Tanzania, and also expanding our appetite for the public sector. So here you will see that our corporate loans have grown and are now at 70% of the total loan book, corporate deposits at 37% of our total deposit book, and operating income at 41% of total income. If we look at personal and business banking, where we've been increasing our relevance, we have also done well in this space, in particular through really revamping and growing the value propositions we have for our customers here. Looking at the personal and business banking segment, it grew by, over the 3-year period, by a CAGR of 29%. And we have seen new products growing in this space, unsecured digital lending. We've been doing supply chain financing and stock financing as well. So moving on to or actually just highlighting the numbers over there, you will see that the contribution to total operating income from our personal and business banking segment is now at 49%. And the deposits there growing quite healthily. You can see 28% growth just in 22 to 23. Our next slide really just captures some of the outcomes of what we have been investing in over the years. Imara 2.0 was predicated on really leveraging digital capability. I think we've talked in the past about the digital factory that we built, and you will have seen the introduction of INM OTG, not just here, but also now in Uganda. And you will see that 81% of our group transactions have now been executed digitally, with a total transaction value of 1.2 trillion Kenya shillings. The NPS score has also moved higher because, as we have spoken about before, really digital helps us with how we service our customers. So it's much easier really to get servicing and fulfillment over the digital channels. And at 71%, that's a very, very high score if you compare it to other sectors and certainly within the industry. So we have invested and continue to invest in our platforms. We changed our card management platform and have introduced digital lending solutions in Kenya, in Tanzania, and in Rwanda, and are continuing to look at how we can integrate with other payment applications, including with the government systems that enable payments into various services offered by the government. So if we move on to our investments in people, this is our greatest asset, and we have focused on how we can continue to empower our people, particularly through developing new leaders, making sure that we are upskilling our staff, and also focusing on diversity and inclusion. The cultural transformation program that we run, we have called Pamoja, and the slogan that you see there, Together We Shine, intended to make sure that we focus on doing things together. In Mauritius, we have a different name for it. We call it ONSAM, but it means the same thing. You will see then that our talent pool program went up by 30%. Those are huge numbers, moving from 2,100 in 2020 to 2,800 staff. So we have been investing in people, we've been investing in our economies, employing more and more staff. In terms of what our people say about how they feel about working in INM, we measure that through employee engagement surveys. And that has moved up from 75% to 78%, 300 basis points rise over that period of time. Our gender diversity, we still have a few points to work on over there, but clearly it is still comparable and reflects what workforce we see in our various countries. And in terms of how many people we are seeing in the senior leadership that are ladies, that has also improved, and we continue to focus on improving that. I guess because some of us are still growing older here in the senior staff, you will see that we have our staff average age ticking up to 37 years. So it still reflects a young organization. Good. So thank you. So you will see the slogan on the right, and it says 50 years of INM Bank. So this year we're celebrating 50 years of operating here in Kenya. And we know that our roots here in Kenya are very strong, and have continued to invest in how we can transport what we feel is our unique DNA into the various markets that we've gone into in the region. And we believe that with our focus on customer centricity, that we really are looking at how we can solve problems for customers, not just in Kenya, but across across our different markets. Investing in this has meant that visibility has improved, particularly as we get into the retail space. And you will see that what we call the spontaneous awareness score has jumped from 2019 at 2% to in 2023, 20%. The different initiatives we've had across the markets, and Gul will talk to some of them later, you will see have really helped with increasing awareness. We recently announced that we are now rated by Fitch, and you will see our group national long-term rating is at A+ with a stable outlook, and the long-term issuer default rating at B with a negative outlook just simply reflects the fact that you cannot be better than your sovereign. But this is something important, I'm sure, for all of the analysts and all our different business partners, and we expect that as we continue to invest in our businesses, it's going to improve. This bragboard just simply captures a few of the awards that we've had over the year. Right, so in terms of our communities, we remain committed to positively impacting our communities. And over the last 3 years, we have impacted over 2.1 million lives positively, in particular partnering with institutions that can help us provide sustainable solutions. We have been particularly looking at waste management, looking at e-waste disposal, and we have managed that with a partner, WEEE Center, to recycle close to 3.5 tons of e-waste. And we welcome you to, at any of our different branches where we have these bins, to actually deposit any of your e-waste, and we will recycle it for you. We've looked at also how we can support our customers through financing their green energy initiatives, and had committed 6 billion shillings, with over 40% of that taken up to help with financing the transition to a green economy. In terms of resource efficiency, we have been looking at tracking this for our own footprint, as well as now extending it to our next level, which is the customers that we work with and the footprint that they have. We looked at the mitigation of carbon dioxide emissions, and we have mitigated about 8.5 tons through recycling of waste that have just been collected within the I&M business, right? We are also looking at how we can reduce our carbon footprint, and we're looking at our scope 1, 2, and 3 operational carbon footprints to reduce by at least 30% by the time we get to 2030. This is a question we've been asked severally, and the last time I think we spoke, we said we were working on a project to just outline what our baseline is, and then we could make commitments. So this is what we have highlighted here. Now, in terms of our I&M Foundation, where we set aside 2% of our profits before tax, I believe we're the only business in this country to have such a high level of commitment. We have supported over 360 scholarships in the education and skills development pillar, created over 370 jobs. Over 500 women have been supported to enhance their incomes through our partnerships. That's the enabling giving pillar. We've impacted over 13,600 lives. And our focus on the environment has also helped to allow our partners, particularly schools, to support the growing of over 420,000 trees. So through the period, we have invested over 832 million shillings in all of these foundation initiatives. And we continue to do so, not just here, but also across the group. Good, so let's turn to the numbers. And you will have seen that we've already announced this, and these numbers will also be available on our website. So all of these initiatives come together to drive our numbers. In 2023, our operating income grew by 20%, That's a compounded annual growth rate of 21% over the last 3 years. Our expenses grew as well, reflecting the investments that we've been making in our platforms, in our people, and in the elevation of our brand. You will see that year on year, our profit before provisions, so our operating profit, grew by 14%. And this in particular rose from the new lines that we have been expanding in the retail space, but also the sector expansions like we talked about on the corporate side. And our subsidiaries have also been doing very well, and the increased contribution that we've already discussed, despite all of the different challenges we've seen in various markets. So we've done, we feel, very well. You will see that our cost-to-income ratio reflects the kind of investments that we've been making, and you will see that our cost of risk at 2.1%, 2.5%, reflects the kind of environment we've been operating in. If we turn to the group balance sheet, you will see that our assets have grown in the last year quite dramatically. Yes, indeed, there has been some contribution from the currency movements that we've seen in the various markets, but by and large, it has actually been driven or underpinned by business growth. So loans and advances up 30% year on year, and our very big focus on deposit mobilization led to CASA deposits growing by 49% year on year. And that's a 5% improvement on the CASA ratio year on year. The increase that we see in the non-performing loans really is a reflection of the difficult macro environment that we have seen, particularly here in Kenya. Nevertheless, we maintain very strong capital adequacy and liquidity ratios. And if you look at the next slide that speaks to it, you will see we have highlighted the various country liquidity ratios and the capital adequacy ratios as well, relative to what are the regulatory ratios as well. So, a quick highlight really of the Imara 2.0 scorecard. We have grown our profitability from 10 billion shillings at the start of the plan period, that's at the end of 2020, to 17 billion shillings by the time we got to 2023. And this despite a very complex operating environment in which we have had to deliver our plan. Our return on equity also improved from 13% to 15% during this period. We know that as we continue to leverage the investments that we've made, this is set to improve. And the focus on our customers and innovation has also paid off. You will see that our digitally active customers at 78% is up from 74%, and the NPS that we had already discussed at 71%. So if we then now go through the subsidiaries, I will invite Gul Khan, who's our Kenya CEO, to just talk through the performance for Kenya, and then I will return to discuss the subsidiaries. Thank you.
Kihara's taller than me. Good morning, everyone. Good morning. Thank you for coming today. Let me just highlight the results for Kenya. So as you can see, we increased our revenue in 2023 by 14%. Our profit before tax was flat. On the positive, our customer growth, as Kihara alluded to already, grew very strongly, 26%, and our deposit growth again was stronger than our lending and growing 31%. On the profit before tax, which is flat, this was really impacted by the increase in provisions, about 31% increase in provisions, which reflects the challenging environment we had in 2023 and also a prudent approach to provisioning. As you can see, our cost-income ratio increased slightly. This is really because the investments we made in our technology, our digital applications, our mobile app, our online banking, as well as our people, getting the right talent into the organization. But we are very confident this will continue to give us a good payback. On the return on equity, you can see we came over 17.4%, which is a healthy number given the environment we were operating in. As Kihara alluded to earlier, we've had a really good progress in our CASA ratio. So we've had significant growth in deposits year over year. But what's pleasing to see is our CASA ratio has increased in Kenya by around 6%. And this is a key priority area for us. On revenue from new business, during the Imara 3-year period, we're now nearly at 25% of our revenue coming from new businesses, which again has accelerated, and we're pleased. You can see some of our key marketing campaigns we did in 2023 in Kenya. The Nisare Kabisa, which is the free bank to M-Pesa, free bank to Airtel Money for personal customers, and also our largest personal unsecured loan of 10 million. Most banks are much lower than this. These contributed as well to our growth in 2023. We're pleased with our customer growth, and this is something we want to highlight. As you can see, our customer base increased over 27% in 2023. So 1 year, we've increased our customer base more than 1 quarter. We're confident to say that we believe we have one of the fastest growing customer bases of all the banks, of all the top banks in Kenya. And this is something which we think is going to drive a lot of growth for us in the future. Equally, we want to see customers coming to the bank, but then becoming sticky, becoming loyal. And on the right-hand side, you can see significant growth in the digital transactions our customers are doing on our platforms. So you can this is just the 4 quarters of last year. You can see the significant growth. If you look at the numbers for Q1, we had like 1.7 million transactions from our customers on our digital platforms. And in Q4, it's increased to 4.7 million. So that's significant growth, much faster than the growth in our customers. So this is giving us a lot of confidence as we look ahead to 2024, which is 50 years of I&M Bank in Kenya. This is giving us a lot of confidence that what we're trying to do, which is being relevant for our customers and giving them solutions which are solving their problems, we're on the right path. Not just about digital though, we're mindful we need to be closer to our customers. We have opened 8 branches recently in Kenya, and we're planning to open 12 more branches this year as well. Again, just to make sure we can service our customers. I'll stop there for Kenya. Hand you back over to Kihara. Thank you.
Thank you, Gul. We're doing a bit of ballet over here, managing these stairs. So, Gul has talked about our performance in Kenya. We'll just highlight the other subsidiaries. So with Tanzania, a 2% contribution to PBT, representing 8% of our total assets in the group. And this has led to really over the plan period, a CAGR of about 27% over the last 3 years. The performance in 2023 was really underpinned by asset growth, and which has led to over 68% growth in our net interest income. And our non-funded income also did well, growing by about 26%. and partly attributed to growth in the FX income space. While the operating expenses also increased by 26%, this was driven by general costs, continued investment in the business, and importantly, the PBT ended up positive from a loss that we had posted in the previous year. And our capital adequacy and liquidity ratios, as you saw earlier, also remain at acceptable and strong levels. Turning to Rwanda, we had a 12% contribution to PBT, and our business in Rwanda represents 15% of our total assets. The operating income there grew by, again, 27% compounded annual growth over the last 3 years. In 2023, the growth was driven by net interest income, which saw an 18% rise, and also a 30% increase in non-funded income, again supported by FX, but also importantly, the penetration of our services in the Rwandan market and the preference by customers of I&M Rwanda to do their banking business with us. The operating expenses also grew by about 26%, and this reflected the investments that we're making in IT and also the provisions that we'd made on the MasterCard incident that we'd had a couple of years ago. The loan book grew by 48% year on year, and as did deposit growth, with CASA standing at 90% in 2023, which is up from 83% in 2022. Again, the capital adequacy and liquidity ratios also very strong. In Uganda, this is coming along very nicely. This is now our third year of operation as I&M Uganda, and a 3% contribution to PBT, representing 7% of our total assets. We saw the performance in 2023 really boosted by net interest income growth at 52%. Non-funded income growth was also strong at 19% year on year. We are continuing to invest in this business. We've just changed the core banking platform very successfully this year. Also changed the digital platform. They're now operating on I&M OTG as well. And we expect that this business is going to continue to grow from strength to strength, and the returns on equity will continue to improve. The loan loss provisions did increase during the year, which depressed the PBT somewhat, but it remains a business that we know is going to be very resilient over the years. In Mauritius, very strong performance, an 8% contribution to profits before tax for the group. You'll remember that Mauritius is a JV, trades as Bank One over there. And operating income grew by 16% over the last 3 years. And I'm sure you will all recall that for Mauritius, this was the COVID period was actually quite challenging. So to see the bounce back has been very, very good. In 2023, we saw operating income grow by 41%, driven by net interest income growth, which grew about 52% year on year. The balance sheet continues to grow, and as the economy continues to expand, the PBT increased by 80%, driven by the different lines that I've just discussed, and as well as recoveries that we had in the loan book. Good performance on the ROE side, returns on equity at 20% in 2023, and the net NPA, while it ticked up in 2023, it represents our investments that we'd made in one of our challenged economies in the continent, which is Ghana. And however, we are seeing recoveries going well there, and we expect to recover most of our investments in that space and see that ratio come down to the target levels for the business. So we've discussed Imara 2.0, and we mentioned that we've closed the strategy cycle in 2023. We are now turning our heads to the new horizon, which is Imara 3.0. The first part of our journey under Imara, so Imara 1.0, really focused on key priorities of replatforming our business, starting to build the foundations on our digital and digital platforms, and also changing the group operating model to make sure that we are a more cohesive group. And we saw continued dominance in the corporate space as one of the key outcomes there. At the time, I&M at 85% of group profit and cost-to-income ratios of about 45%, one of the industry-leading cost-to-income ratios. Imara 2.0, which we've just closed, we continue to build our value propositions for our customers, which enhanced our share of wallet for our customers. We diversified the various sectors that we were in. And we saw as key outcomes the contribution coming from the retail and personal and business banking space rise, and you're almost at 50-50 now. And in terms of contribution from the subsidiaries, that has then risen quite well to 24%. Our cost-to-income ratio there has reflected the investments that we've been making through this period. And when we now look to the new horizon, this is Imara 3.0, we are focusing now on scaling our new businesses. And the key priorities will be accelerating our growth in these priority segments and also focusing on impact. So we're looking at beyond profits, how impactful can we be to the communities in which we operate. So our key outcomes that we are looking at getting more than 1 million customers. We are already halfway there. The key participation choices that we will have are to develop leadership in our core segments. We have already talked about how well we feel we do and want to do in our corporate and commercial space and in the premium banking space as well. We are looking to also build relevance in our emerging customer segments, so the retail and MSME space, the retail and SME space. If you consider our economies across Africa, we are really powered at the end of the day by the SMEs that we have, and we have perhaps about 40% of our people employed in the SME space. However, in terms of penetration, we don't have too much penetration by banks in this space, and quite a number of SMEs remain unbanked. So we want to be part of the solution in changing that. We also are looking to leverage the digital foundation that we've built and look at our core segments in corporate to really build ecosystems that we feel can then serve our customers well in terms of developing solutions to the issues that they have in their particular value chains. And at the same time, obviously, solve for some of the challenges that we see financing right at what we call the last mile. We're going to be investing in brand relevance, in making sure we are more harmonious as a group. Resilience is really critical to a business like ours, so that will continue. Digitization is something that is only going to get faster and more necessary, and we are going to continue to improve on that space. And of course, as we said, our people are the ones that deliver the performance that you see. We want to continue investing in cultural transformation to make sure that we are equipping our people with the skills that they need to be able to deliver in this new dispensation. Now, we talked about the need to focus on impact, and that's on the sustainability side, really. We've talked about the 10 million lives we're looking to impact over the planned period. But we also are more deliberate now about sustainability. We spent 2 years just working on a project to understand our baseline, how we best should interact, and how we should really formulate our sustainability initiatives. We have outlined a long-term ambition for our sustainability space, and that is to positively impact 50 million lives by 2030. By 2030, because this aligns with the UN SDGs, and we have picked several of those that we want to focus on. We have joined the UN Global Compact and are looking at how we can work together to really deliver this positive impact by 2030. In terms of impact, I've already talked about the 3-year target of 10 million, but we're looking at how we can enhance business sustainability. How do we make sure that we are doing business ethically? We are making sure that we are supporting local businesses. We are looking at catalyzing $50 million of funding across various initiatives. And what will be our participation choices, therefore, is how we finance last mile financial solutions. We're providing last mile financial solutions to ensure that there is inclusion, there's access to finance, and that there's actually usage of these financial services. We want to build sustainable businesses, as I talked about, and ultimately we want to be part of the solution to enhancing the quality of life in our societies. The approaches that we will take to enable this, our ecosystems and partnerships will give us the scale that we need. We will be looking at collaboration with like-minded partners, and we'll continue to leverage the different initiatives we have under the I&M Foundation, not just here in Kenya, but also across the group. In terms of, therefore, the key outcomes that we are looking at for Imara 3.0, our digitally active customers will rise to 85%. Our NPS will remain very high at the 70% and over mark. We'll be looking to grow our customer base to over 1 million customers and to truly be seen as the best bank by our employees. So we will also be looking at high employee engagement scores as we impact all of this lives. So, in summary, before we get to Q&A, our PBT up 11% at 16.7 billion shillings for the group. The total income was up 20% year-on-year at 42.7 billion shillings. The cost of risk reflecting the kind of environment we were operating in last year at 2.5%. Loans advances, very strong growth there to 311 billion at 30% growth. Customer deposits also strong growth for 17 billion. And our ROE, an absolute increase of 0.1%, still very strong at 15%. The summary on the financial metrics, EPS in 2023 strong at 7.6. The book value per share is at 53.3. We track this importantly because we understand that it's not very easy to tell what the intrinsic value of our businesses that are listed on the stock exchange are. So our book value per share, you can see very strong at 53 shillings 30 cents per share. And that has been rising over the period. The dividend per share, we are paying a dividend of 2 shillings 55 cents. Which is up 30 cents on the previous year and represents 32% payout, which is still very, very strong. We are always focused on making sure that we have enough capital to support the strategic initiatives that we have. So obviously when we are making our capital decisions, we also look at the payouts that we have and can we really support the initiatives that we have across the group. This represents a dividend yield of 13%, which is comparable to the previous year, and still one of the strongest dividend yields that you will see on the exchange. So I'll stop there And we'll move on to the next phase. I want to thank you for being attentive and invite your questions.
We'll now start the Q&A session, so we'll just set it up in 1 minute and then we'll begin. Invite Gul, Gori, and Billy to come up on stage as well. Okay, so we are ready to start the Q&A. I'll just run through another quick introduction so that you know, if you had forgotten, who's on the panel. So that's Gauri Gupta. She takes care of our corporate advisory. I don't need to go again, Kiara and Gul. And then this is Billing Etich. He's our acting group CFO. So any questions from the room first?
Yeah, hi, Sunil Sanger from Orion Advisory Services. Kiara and the team, good set of results. The only concern is the rising NPL ratio. How do you see this developing in the current year and going forward? Are we near the top of the NPL ratio and we see it declining, or are we still seeing challenges on that?
I'll take one more and then the panelists can answer.
Yeah, morning everyone. Justin Mwangi from SBG Securities. So a couple of questions, a good set of results. But one of your goals is to reduce the cost to income ratio to below 45. And it seems the biggest challenge here is regional subsidiaries. So from your point of view, why is the cost to income ratio for regional subsidiaries that high? I'm seeing 60 to 80%, and it's been perennially higher than Kenya. And what will you do to get it down? Secondly, your operating expenses rose quite sharply, like it almost eroded the strong income growth that you saw. Is that purely because of the branch expansion? And when do you see an end to this physical presence expansion and for you to start sweating branches a bit more? Thanks.
Thank you. So I think on the first one for NPL, Kihara, you can take it. And then Billy, you'll take the question on cost to income ratio. And then operating expenses as well. But Gul, you can speak to the branch expansion bit.
Thank you, Sunil. And indeed, we have seen some very challenging operating environments in the past 3 years, certainly in the last year, across our different markets. I think we touched on earlier the macroeconomic challenges that were behind that. We've seen policy responses that have then talked to how we can deal with those macroeconomic challenges. So rising inflation has led to markets, the central banks in the markets in which we operate, also focusing on increasing interest rates to contain, number one, inflation, but also deal with the challenges of currencies. I think in our key markets, we've seen that starting to plateau. And we are going to start seeing I think the downturn in terms of interest rates and more stable exchange rates. What we know is that when you have higher interest rates, you expect, number one, that customers are going to also struggle a bit with their facilities. They will also make choices about whether or not to take on more debt in their books at such high levels. Typically, the idea behind rising or raising interest rates is to reduce the amount of borrowing that is happening. So really only the clients who feel that they must absolutely take on debt are doing so. And we will, from the bank side, be watching that very closely to see whether they can actually afford it or whether they will struggle with debt. So I think we will start seeing that change. We're not out of the woods yet. Maybe towards the later parts of the year, going into the next year, we will see that pressure continue. From our side, what we focus on is how to support our clients through this period. Where we need to restructure, we do. Where we need to be more aggressive in really collecting on debts gone bad, we have also built teams to support that. So not out of the woods yet, but we can expect that we'll see those green shoots coming later in the year.
Thank you for the question. So it's about cost-to-income ratios across the group. And yeah, rightfully put it, from subsidiaries, we are seeing the high cost-to-income ratios. So one of the sub is still new, right? So as the revenues pick up, of course now, this is Uganda, as the revenues pick up, definitely we'll start seeing the cost-to-income ratio tapering downwards. The other driver in that very sub is that we redid the core banking system. So definitely in the nascent years of that new system hitting the P&L, you will definitely see that cost to income having to shoot upwards. But that said, of course, also we have a good number of our invoices in hard currency. So we also had to take in, additional currency hit to the cost line. Thank you.
Just on the question on branch expansion impacting cost-income ratio. So if you look at our cost increase in the last year, it was predominantly with technology and staff. So we invested a lot in our digital banking. We do believe our app is the best in Kenya, and we're confident enough to say that, but it takes a lot of investment as well, and optimization. Because obviously there's a complex infrastructure, with core banking, middleware, and then the digital applications. And obviously people as well. We've expanded our retail, both in terms of salespeople and branches. We don't see the branches as actually a major part of the costs, but it's as a strategy choice we've made. We will be opening more branches. We think we don't have enough. We need to be closer to our customers. And the new branches that we've opened have performed. It's still early days, but they perform very well compared to our internal business cases.
Good morning. My name is Linda Libese from KNCCI, Kenya National Chamber of Commerce. And it is good that I've just heard about MSME. And you know what we do, and I was just asking about one of the key accelerators that you talked about is the SMEs penetration. And now you people are in East Africa region. We find that we have some hurdles that we encounter with the small, the MSMEs. How do we handle them? For example, they can have an LPO that they would like to be financed, and you find that LPO, because of the asset finance base, they say that you bring a collateral for you to be given a loan. How do we handle such kind of so that we can grow the MSME group?
A question from the room?
Thank you. My name is Ronnie Choka from AB Axis. I have 2 questions. Firstly, when I look at the yield on interest earning assets, at a time when yields last year generally, we saw, let's say, the 91-day T-bill accelerate 600 basis points. I can only see a little momentum on your yield on interest earning assets, just about shy of 1 percentage point. Why is there a lag in the reinvestment returns from a group perspective? Secondly, I also noticed, but you alluded to the cost-to-income ratio in Uganda business picking up pretty significantly, but I think you've answered it comprehensively. So I think that first question on the reinvestment returns, government securities, and also the top line. interest earning from loans and advances, how much of this reflects volume growth and how much of it is risk-based pricing reflection? Thank you.
Thank you. So Gul, you'll take the SME question. Kihara, you'll take the question on the interest earning assets, and the final question.
So on the MSMEs and giving them financial inclusion and access to credit, and the best way to do that, because it's a very good question you've asked. I think it's a challenge for everyone, all the banks. I think there's a lot more we can do. But fundamentally, to answer your question, for that segment, a lot of these small businesses really operate in the informal sector, right? We have to get much better at scoring alternative data sources which these customers have, right? So, that's the journey we're on. So we lend to small businesses, MSMEs, we even lend to them digitally, but we have to not just rely on their transaction history with the bank, right? We have to get alternative data that they have and use that to score. And I think you're already seeing it in Kenya. There's a lot of good fintechs already in Kenya which are trying to play in those segments and give financial inclusion to MSMEs. But the approach has to be by really, getting much better at data scoring using those alternative data sets.
So on why there is a lag in the pickup on yields, I think one of the core things that a bank has to do is asset and liability management. And we appreciate that the transmission mechanisms in the financial services industry are not necessarily that strong. I know we've been talking about risk-adjusted or risk-based pricing being adopted over the last 3 years, particularly here in Kenya. But the reality is that even as interest rates are rising, you already have a stock of interest-earning assets, particularly government securities. And as you know, roughly about 88% of our government debt is actually in the bond space, shall we say, which means that it won't reprice as quickly, even if interest rates are going up, right? And if that's what's available for banks to invest in, then you expect that it's going to be sticky for a while, even as interest rates are rising. So that portion explains why you will see that lag. However, when it comes to adjusting the pricing on the customer loan book, you will, number one, be dealing with the need to advise customers that your rates are going to change 1 month in advance, right? So even as the rates were rising, we were also looking at, number two, how do we help our customers? How do we cushion our customers as best as we can? Because we know, yes, the rates are rising, people have to adjust to this and all. So we took a bit of the hit for customers initially, until, of course, we felt that we really do have to transmit this increased pricing. So, and we're also cognizant that the idea behind raising interest rates is really to send a signal out into the market that there should be less borrowing, as it were. So we had to do our bit as well. But we have continued to strengthen our asset and liability management capability. You had the introduction of Ken Lukale, who is our head of ALM, and we are continuing to strengthen the process of asset and liability management across the group to make sure that we have a responsive structure to changes in interest rates.
Yeah, Gori, we have 2 questions online. So the first one from RG, what is INM doing to reduce the gap between the BV and share price? And the second question, still from RG, is why is INM's DPR at 33% compared to the peers?
Okay, thank you. I think on the book value versus the market price, this is not something we as the issuer can control. the price on the stock exchange or the securities is determined by investors. One, and secondly, also a reflection of the macroeconomic position and generally how the stock exchange is doing. So for 23, for example, we see all the three indices in Kenya drop by between 20 to 25%. So really the price is a reflection of so many factors, most of them not in the control of the issuer or I&M, so to speak. To the second question on the dividend payout ratio, I think Kihara alluded to it during the presentation. I think every bank, every board has to see several or take into account several considerations before we come out with the payout ratio. But what's important to note is that I&M is on a growth and an expansionary strategy, which requires significant investment in people, our distribution, technology, etc. And the payout ratio reflects the amount of capital that's then goes to be reinvested in the business. So, but having said this, I think the board is very conscious about making sure that we at least pay out 30%. And, we have been progressively growing that ratio. So, if you look at 2020, 21, we were in the range of low 20s, and we've gone up to by 10% to just over 30%. Thank you.
Any other questions from the room? There's one at the back.
Thank you. Good morning. My name is Wakife Chege from Sanlam Investments. Congratulations on the good set of results. I just have one question. As part of Imara 3.0, the target of achieving 1 million customers by the end of the strategic period, in addition to organic growth for I&M, are there any brownfield opportunities? Do we see any mergers or acquisitions in the pipeline? Thanks.
Take the second one.
Yeah, mine is just a response to the answer that Gauri gave on the last one, a bit of the difference between the share price and the book value. Now, this is commonly what we hear management saying, that there's nothing we can do. But there is something called share buyback. If your share value in the market is so underpriced, there's no ROE that can be better than buying back your own shares. I mean, if you can buy back your shares at 25 and the book value is 50, it's a straight 100% ROE. Why is this something that's not ever given as a response?
Okay, I'll take the questions in the order. So on mergers and acquisitions, yes, we are looking at mergers and acquisitions as part of our Imara 2.0 as well as Imara 3.0 strategy. We're looking at expanding into the Eastern Africa region and also increasing our market share in the countries we are present in. On the pipeline, I think unfortunately at this stage we cannot share information, but at the right time, once things have crystallized, we'll definitely share the news. Sunil, thank you on the share buyback. I think this has been a question that keeps coming up, and we did look at this seriously, spent some time on it, and unfortunately the board took a view that it was not in the best interests of all the stakeholders. So it was left at that.
Gauri, any other questions from the room? These two at the back.
Yeah, just a follow-up on Sunil's question. I would want to understand how a buyback is not in the best interest of all the stakeholders here, because especially for the shareholder, that would be a very key component. And then there are two questions more. One is on the mark-to-market valuation of the HTM book. How big is that? And then a final question on what percentage of your loan book is priced in dollars? My name is Eric Mokaya from Mwango Capital.
Thanks, Eric. So, Gori, you'll just clarify on the first bit, and then Billy, you can take the last two.
Sorry, I didn't get your name, but maybe we can have a separate discussion after this, and we can go through some of the more detailed considerations. Yes, shareholders are one component of this, but there are others, including regulators and other components. So let's have a separate chat maybe after the session on this.
He's Mokaya from Mwango Capital, so we'll organize a one-on-one for that. Billy, please take the other two questions.
Okay. Direct answers to your questions. Dollar loans or FCY loans account for about 32% of the balance sheet, 32%. And then, and of course, as customers want to shift between currencies, I would advise them, and we wouldn't take dollar exposures for customers in shilling inflows. So the credit process, of course, will now look into those just to make sure we are not exposed unnecessarily. Then in terms of the HTM, so those ones we hold to maturity, and they would account for about 25% of the total holding book in government securities.
Thank you, Billy. There's one more question.
Okay, my name is Maximila Fula, right for the County Daily News. My question goes to the CEO towards the green energy. From the financial year, you have let the impact of the green energy towards the A&M group. Okay, my question is, how has the A&M transition towards green energy and sustainable practice impacted its financial performance and strategic direction in the financial year 2023. According to your modules of presentation, we find that you had the higher increment in terms of customers from 250 up to 560. So can you explain it in terms of green energy transition? Thank you so much.
So it was a bit unclear, but let me try and recap. So you want to know how our energy transition initiatives have impacted our 2023 performance and how that's going to look in the customer acquisition side as well. Is that it? Good. So I mentioned that we have committed 6 billion shillings in funding to green energy, and 40% of that has already been taken up. The reality is that converting into a green business, as it were, takes a lot of investment, and you have to look at the trade-offs as a business on whether or not it is going to give you any advantages other than the fact that you're saving the planet. You have to have commercial concerns. Oftentimes, the access to cheap funding is not very strong. And this is something that we have been discussing with our development finance institution partners on solutions that can help with uptake because it is more affordable and actually can get our customers across that initial hurdle so they can invest in rejigging their businesses to be actually more green and qualify for the funding. So it's been a bit slow, but the big area that we have seen has been in the energy space, the solar energy space in particular, and that represents a large part of the take-up that we have seen of the green funding. We have also seen the recycling of plastic as well is a key focus area for some of our customers looking at green initiatives. I'm sure these are going to continue to grow. There are very many different aspects of this. There's obviously some of the initiatives that have been put in place through regulators looking at climate risk, and all this present opportunities. We are also looking at more, signing up more finance from development finance institutions to support this area, and all of them are really keen, particularly in the SME space. We are also looking at sustainability initiatives through our I&M Foundation. How can we give people better access to clean cooking, away from firewood, so you can preserve forests and so on. We expect that as this grows, this is also going to attract more and more clients that are interested in being part of the solution. So part of that 1 million target growth that we're looking at is certainly going to involve people who are working with us as partners and as clients in the green space.
Thank you, Kihara. Any other questions? Okay. Mokai, have another question?
I think the question on HTM is what would be the impact of mark-to-market on those HTM securities? That would be the more pertinent question to that.
So we have three classes of assets, the fair value P&L, OCI and HTM. So the HTM ones, if we don't check them through, we don't revalue them on an ongoing basis. It's the OCI element that we would mark to market. So if we were to stress test our balance sheet, we will still be resilient in terms of sufficient capital. I think almost the same quantum as what you would see being what we report under OCI. Right.
Sorry.
Morning. My name is Clarence from ABC Capital. My question is really based on diversity. Maybe I haven't heard you mention anything, maybe considering things like Islamic banking. Are you considering bringing into the fold people like those to give you their capital? And yeah, maybe is it something you're considering? Because it's also a market that is out there. Yeah.
Good.
Thank you. Yes, we're exploring it as we speak, Sharia compliant financing, because our customers are asking for it, especially on the coast and in pockets in Nairobi as well. We've opened our branch in Eastleigh, in the new fantastic mall, Business Bay Square, and there is demand, so we need to respond to that. But we want to make sure we do it properly, without any shortcuts, so just bear with us. It's not something we can do overnight, but we are exploring it.
Any other questions? Okay, thank you. That brings to a close the formal Q&A session. However, as we said, we have set up opportunities for one-on-one, both from the media side and the investor side. So for the media side, we will run through them with Gul and Kihara. For the investor analysts, Gori and Billy are available as well. So I think we'll start off with Mwango on that one, and then the investors as well. If you haven't registered your interest for one-on-one session, Deepna is at the back. Please let her know so that then we can run through those. So that marks the end of the formal part of this session. I want to thank you very much for joining us this morning, either physically or virtually. We are now going to reopen breakfast as well for everyone. So if you didn't have something to eat, please do so. And then we'll carry on with the one-on-one Q&As. You'll pick up something on your way out at the media desk. And we really, really do thank you.